let's be real for a second. Personal finance, it can feel like you've been dropped into some advanced math class you never ever signed up for, right? It's all jargon and complicated numbers, and honestly, it can be a little stressful. But what if it didn't have to be so complicated? I mean, think about it. The minute you hear terms like compounding interest or asset allocation, does your brain just kind of fizzle out? If it does, you are definitely not alone. But here's the good news. You absolutely do not need to be a math whiz to build wealth.
And that's exactly what we're going to do right now. We're going to build out your own personal financial toolkit. Think of these as simple, powerful rules of thumb, mental shortcuts really, that can help you make way smarter financial decisions every single day with a ton of confidence.
Okay, first things first. Before we can even talk about growing your money, we have to build a really solid foundation. This is all about getting those fundamentals of budgeting and saving totally locked down. This is probably the most basic question in all of personal finance. And you know what? Thankfully, there's a beautifully simple answer. It all starts with knowing exactly where your money is going. So let me introduce you to the 50-30-20 rule. It's a super straightforward way to split up your take-home pay. 50% is for your needs, the essentials like rent, bills, groceries. 30% is for your wants, all the fun stuff like vacations, new gadgets, or eating out. And then, and this is the most important part, a full 20% is dedicated to your financial future, your savings and investments. Okay, so you've set aside that 20% for savings. Awesome. But the next question is, when do you actually put that money to work? Do you just wait till the end of the month and invest whatever's left? There's a much, much better way.
This is where the first week rule comes in. And trust me, it's a total game changer. Instead of saving what's left after you've done all your spending, you completely flip the script. You invest first. So if your salary hits your account on the first of the month, you set up your investment for the 5th. This simple change forces you to live on what's left, which guarantees you always hit your savings goal. The mantra is simple: invest first, spend later. Look, life is unpredictable. A medical emergency, a car repair, maybe even a sudden job loss. These things happen. So, how big of a safety net do you really need to have sitting in cash just in case? And the rule of thumb for that is the 6 by emergency rule. The goal is to have 6 times your total monthly expenses tucked away in an account that's liquid and super easy to access. So if your monthly bills and expenses come out to, say, $3,000, your target is an $18,000 emergency fund. And remember, this isn't money you invest, it's your financial firewall. All right, foundation is secure, emergency fund is in the works. Now it's time for the really exciting part. We're shifting gears from just being stable to actively growing your wealth and making your money work for you. This is a big one. It's where a lot of people get kind of stuck. Stocks, bonds, other assets. How in the world do you decide on the right mix? Well, guess what? There's a great little rule for that too. It's called the 100 minus age rule. All you do is subtract your current age from 100. The number you get is a rough percentage of your portfolio that should be in equities or stocks. So if you're 30, you'd aim for about 70% in stocks. As you get older, your stock allocation automatically gets a bit more conservative. Now, this is a general guide, of course, and it works best if you don't have any major loans or debts hanging over your head. Have you ever looked at an investment that's promising like a 10% return and thought to yourself, okay, that sounds great, but how long will it actually take for my money to double? Well, you don't need some complicated financial calculator to get a quick estimate. Check this out. It's called the Rule of 72, and it's just brilliantly simple. You just divide the number 72 by the annual interest rate, and that tells you roughly how many years it'll take for your investment to double. So an investment with a 10% return, it'll double in about 7.2 years. It's a fantastic mental math trick, and it works best for interest rates somewhere between 4 and 15%. So building wealth is one half of the equation, but protecting what you've built is just as critical. This last section is all about managing your risk and making sure your financial future stays secure. Let's talk about debt. Whether it's a home loan, a car loan, or student loans, it is so easy to get in over your head. So how do you know what's a safe amount of debt? How do you know when you've taken on too much? Well, the 40% EMI rule gives you a really clear boundary to follow. Your EMIs, that's just a fancy term for your total monthly loan payments for all of your loans combined, should never, ever be more than 40% of your monthly take-home pay. This simple rule helps make sure you have plenty of cash left over for, living your life and hitting your other financial goals. This one is huge, and it can be so confusing. Insurance can get really complicated really fast, but the core question is actually pretty simple. What's the right amount of coverage to make sure your family is protected? Here's a great starting point: the 20 by insurance rule. You should aim for a life insurance policy that gives you coverage of 20 times your current annual income. And just to be clear, we're talking specifically about a term plan here, which is pure insurance without a complicated investment part. So if you earn $50,000 a year, you should be looking for a $1 million term life policy.
And now for the big one, the ultimate goal for so many of us, retirement. How much is actually enough? How do you know when you can confidently stop working and start living off your savings?
The 25X retirement rule gives you a pretty solid target to aim for. Generally, you're considered financially ready to retire when your total investment portfolio is worth 25 times your annual expenses. But, and this is a really important detail, if you're planning on retiring early, say in your 40s, you're probably going to need a bigger nest egg, maybe 30 or even 40 times your expenses, just to make sure you can outlast inflation over a much longer retirement.
So there you have it. Your financial toolkit is now stocked with some incredibly useful rules. But before we wrap up, there's one last rule, and it is by far the most important one. You have to understand that these are guides, not gospel. I love this quote because it makes the point perfectly. A pineapple is incredibly healthy, right? But not if you're allergic to it. Financial rules are the exact same way. That 100 minus age rule, it might not work for you if you've got a huge mortgage. The 20% savings rule might be too high or maybe even too low for your personal situation. These principles are your starting point, not the final word. Your own judgment is the master tool. You now have a set of powerful, simple tools to take command of your finances. They can help you budget, invest, protect, and plan for your future with so much more clarity. So the only real question left is, which one are you going to start with?